Welcome to Hong Kong and the Asian Investment Conference. Joining us today to talk about the latest market movements is Stefan Keitel, Global Chief Investment Officer for Credit Suisse. Stefan, markets seem to indicate a return to optimism. Are they right? Is the worst over with?
We have to take into account that the market participants had been clearly too negative with their assumptions for 2011. Everybody talked about a recession in the US, a hard landing in China, an Armageddon in the Eurozone, and a shortfall in corporate earnings. And none of these assumptions came true. So now there's a visible improvement overall, and so of course a rising optimism. But it's interesting, I think there's a difference now between a rise in investor sentiment and the current positioning.
The onward trend has been going on for a few months now. Is it still promising to enter the market?
It depends on the time horizon. We clearly recommend the long-term oriented investors to re-enter the markets step by step. Short term, we are pretty much convinced the markets need a pause, and so we rather think for the next weeks we will be confronted with a kind of consolidation, maybe sideways trending markets, maybe even a mild correction. But this would open the door for renewed buying opportunity.
What important lessons can we take away from the last couple of years and use to navigate today's market environment?
First of all, diversification was, stays and will be key also in the future, and this of course is the main investment philosophy aspect of Credit Suisse. Second, we think buy and hold for equity investors is not the appropriate strategy, and I think the last decade delivers visibly the proof. And lastly, when it comes to tactical asset allocation, you strongly have to avoid pro-cyclicality. And here maybe now we have a competitive advantage because the majority of the asset management, portfolio management investor crowd, they locked in the losses in July, August 2011, then they missed the whole rally so far and they are now with the back to the wall. And we are more comfortably positioned because we stick to our assumptions, we stick to our asset allocation, we even increased risk since October 2011 and now started the year with a pretty nice performance.
You chaired the Credit Suisse Investment Committee meeting here in Hong Kong this week. What important topics were on the agenda?
We clearly reiterated that we stick to the so-called real asset call because we think, given the macroeconomic cycle we are in, given the pendulum swing from deflationary threats over reflation to inflation, real assets are the place to be for the long term. We are pretty much convinced that equities, commodities, gold, infrastructure, real estate is a very much better place compared to the so-called nominal assets, in particular traditional bonds and cash. So this was, I think, one of the main decisions.
You touched on commodities. Could you elaborate a bit? What's the position there at the moment?
We are constructive on commodities because it's a part of that real asset call, and given the macroeconomic cycle with these improvements we have seen, and we are convinced we will see further positive surprises over 2012, and the whole emerging market story, we think that commodities generally should be nicely underpinned. It's of course also worth to dive a bit deeper into the different segments. Here, for example, given the emerging market story, setback in growth but still reasonable growth, industrial metals should be nicely underpinned for the longer term. Oil is an exception. Here the valuations are stretched, but that's our geopolitical hedge, because despite the fact that we are fairly constructive for 2012, we have to take into account that risks are still hovering around. And the most severe risk for the markets in 2012 are the geopolitical risks. So oil is not so much our macroeconomic play, oil is very much more our geopolitical hedge.
Thanks, Stefan.
You're welcome.
Stay tuned to AIC TV for more insights from thought leaders.